Good day, everyone. My name is David Williams, Executive Director of the International Association for Energy Economics. It gives me great pleasure to welcome you to today's webinar entitled Trucking and Transportation, the Challenges to the Energy Status Quo. We are grateful to our moderator, John Kingston, our distinguished panelist for today's timely discussion. First, a little bit about the International Association for Energy Economics. We are the largest association specializing in the field of energy economics and provide a forum for the exchange of ideas, experience, and issues among professionals interested in the field. The organization produces 2 professional journals, a newsletter, and holds conferences and virtual presentations, along with a host of other products and services you can find on our website at www.iae.org. If you're not already a member of the association, we welcome you to join. A few housekeeping matters in regard to today's webinar before I hand things over to our moderator. First, this webinar is being recorded for those that cannot participate in today's live event. If you have questions for our panelists, please click the Q&A button at the bottom of your Zoom window and type your question. We've allocated time at the end of the webinar to address your questions. And now I'd like to introduce you to our moderator, John Kingston, Editor-at-Large at FreightWaves. John, over to you.
Dave, thank you very much. And I want to thank everybody for joining us today from all over the world for this IAE webinar. I'm a big fan of IAE. I'm very sad that the Austin meeting isn't going to take place this year. We hope we all see you in Austin in 2021 and also at your regional meetings. So I am the editor-at-large at FreightWaves. In just a few short years, FreightWaves has become the largest source of online news and data about the trucking and freight sector. And our Sonar Market Dashboard is a key source of that data, and you can check us out at freightwaves.com. Before I joined FreightWaves, I spent more than 32 years at, there's the shot of what the FreightWaves homepage looks like, along with some key points about our organization. So before I joined FreightWaves, I spent more than 32 years at what was McGraw-Hill and is now S&P Global. And for about 29 and a half of those, I was with the organization that is known now as S&P Global Platts. And to be honest, during that time, I didn't spend a lot of time thinking about diesel or trucking or its impact on energy demand. Of course, gasoline is the biggest part of the barrel in terms of transportation fuels. I probably also spent a lot more time thinking about the bottom of the barrel, because for Platts, the fact that the bottom of the barrel has always been relatively not opaque in terms of price transparency meant that it was a pretty significant business opportunity for Platts, continues to be, and where diesel was certainly a lot more transparent. But let's face it, about 30% of the barrel goes into distillates. The biggest chunk of that is diesel, so it is an extremely important fuel going forward. So the fact is that even though I might not have been thinking a lot about it, a lot of people were thinking about it. And I think to drive that home, just recently, Nikola Motors went public. Its planned product is a hydrogen-powered truck. It produces no vehicles. I think its only revenue is what cash it burned from its earlier investment. And yet, soon after its IPO, it had a bigger market capitalization than Ford. So that just shows you how much interest there is in the question of how trucks are going to be propelled in the future. When it comes to cars, we can talk all we want about cycling, carpooling, whether work from home or growth in work from home is going to have a significant impact on gasoline demand and whether there's going to be destruction of gasoline demand going forward. But when it comes to the role that trucking plays, there's really no easy substitute. And the fact is we're getting more of our goods that we want delivered to our home via a long distance truck for part of it and then a smaller truck for the last mile. So the demand for trucking services is probably going to increase, not decrease, as opposed to gasoline demand, where a lot of people see a decrease on the horizon, not even the long-term horizon, very close. So we're going to approach this issue on the webinar by talking first to the status quo. Our first presenter will be my colleague at FreightWaves, JT Engstrom. JT is the Chief Strategy Officer at FreightWaves. Before that, he worked in the highly respected Transportation Research Group at Schaeffer. He's a graduate of RPI in Dartmouth. After that, we'll turn to Alan Schaeffer. Alan is the Executive Director at the Diesel Technology Forum. It's a group dedicated to research and promotion of diesel technology. He's also got trucking in his pedigree. He spent 13 years at the American Trucking Associations, and throughout his entire career, he's been involved in key public policy issues and organizations. Finally, we're going to hear from Zane McDonald. Zane is the lead transportation and hydrogen energy analyst at S&P Global Platts, though our tenures did not overlap, but I've gotten to know Zane in recent years. Zane previously was with the International Energy Agency, and he also did some work out at the highly respected transportation research team at the University of California, Davis. That team has really been on the cutting edge of alternative, I won't say just alternative fuels, but alternative energy supplies. Most notably, I think you can trace the California Low Carbon Fuel Standard to a lot of the work they did out at UC Davis. So with that, I'm going to turn things over to my colleague, JT Engstrom.
Yeah, thank you, John. And as you mentioned, I was previously an equity analyst in transportation. I was also an investment banker and a management consultant. I've been studying the domestic surface transportation industry for close to 2 decades now, and I've had the benefit of seeing a couple cycles. And the cycle we are in right now is one of the most unique in that we have 2 large primary macroeconomic factors impacting the surface transportation industry, the largest of which impacting the demand side of the equation is this global pandemic, which has created a bit of a consumer recession and also driven unemployment. And that has happened in conjunction with a large energy crisis, which I know you all know well, which last time we saw energy prices decline at this rapid of a rate, the trucking sector experienced 3 simultaneous impacts. One being a reduction in demand as a result of freight flows, 2, an actual increase in the driver supply due to the reduction of flatbed activity, and 3, sort of volatile economic factors due to the actual impact of fuel prices and the impact of fuel surcharge lags. And so the first chart we're looking at here is a proprietary data set that we hold at FreightWaves. It's in blue is the outbound tender volume index, which is a measure of tendered volumes from shippers to transportation capacity providers. And then in green is the outbound tender rejection index. And the story that this is telling right now is there was a great restocking effort during the sort of March timeframe, which is just when we realized that the pandemic was sort of real and people were going work from home, and people started restocking or not restocking, but fully stocking refrigerators, among other consumer discretionary items, to make sure they were prepared to be locked inside for however long it may be. Nobody actually knew at the time, which then drove a little bit of what I would call a bullwhip effect, with a simultaneous reduction to relative trough in volumes and tendered volumes. And so you saw a peak and a trough in a basically a 2-month period, which is unprecedented when you normalize for some of these other drops in tender volumes, which would really be more appropriately categorized as holiday periods or one-off periods. This was actually more driven due to a prolonged impact for the not needing to restock, which is now being counterbalanced by an uptick in tender volumes back up to, what, with the exception of this past March, would have been peak, or 2-year peak. So it's really interesting that you see both a primary peak and a secondary peak, and a trough in a 3-month period. And so it's one of the most volatile times in freight activity. This is also being simultaneously tracked with a large spike in tender rejections in the March timeframe. And essentially what that's a reflection of is when shippers go to tender a volume to, let's say, a truckload carrier will accept the freight they want and or that they can accept and move, and they'll reject the freight that they either don't want or can't move because it's either not priced appropriately or they just simply don't have the capacity. And so that spiked in March, troughed again in conjunction with volumes in sort of the April timeframe, and is now crawling back towards what I would consider a normalized level, which is sort of mid-single digits tender rejections. Our next chart here is the Cass truckload line haul index. And interestingly, in conjunction with all this volatility in tender volumes, what you've seen is line haul rates have been on a steady decline since the mid half of 2018. And what that's a reflection of is when the hurricanes occurred in 2017, contract rates were renegotiated upwards, which drove this peak in the middle of 18. Bids then reoccurred in 18, and that started a downward decline in line haul rates throughout 19. And we're now seeing a cyclically adjusted trough in 2020. And the question all capacity providers and shippers are asking themselves is, or actually in reverse, all shippers are asking themselves is with this volatility, should I rebid my freight? And if I do rebid my freight, what rate should I be attempting to set it at? And capacity providers simultaneously are thinking to themselves, are shippers going to get aggressive, and what can I do to proactively get ahead of that? As a result, when we look at truckload economics, and this is these are dry van truckload economics. We measured this. This is also a proprietary data set to FreightWaves. This is data that comes from our Engage benchmarking program. And so these statistics come from us taking actual operational and financial data from over 150 truckload carriers to measure what they are actually seeing in the market on a monthly basis. And so what we see in the blue line here is a measure of net revenue per truck per week, which is a core economic indicator for how a combination of asset utilization, driver HOS utilization, revenue per load, and empty mile percentages. It kind of wraps all of that into one core economic measure, which helps you drive effectively a return on assets. And what we're seeing is also simultaneously with the volatility in tender volumes, we're seeing volatility in revenue per truck per week. And with that, though, what we're also seeing is it's more or less troughing or coming to a 5-year low, probably more accurately. We don't know if it's troughing because we don't know if contract rates will be renegotiated downwards. I happen to think that shippers might feel that they have the sort of upper hand and seek to move up bids. We've heard anecdotally that that's already occurring, though it's tough to measure in totality. This green line is the operating ratio of this same cohort. And these two measures are typically fairly inversely correlated because as you increase the revenue activity on your asset base, it typically expands your margins because it's largely a fixed asset business. There are variable costs associated with trucking, and so it's not one-to-one, but if it's a 60% fixed asset cost structure, the more you increase your revenue activity for a specific action item, that drives a lot of margin. And so operating ratios by this measure are coming in around 99.8%. And what that means is truckload carriers are just barely making enough cash flow to continue to replenish their asset base. We're starting to see that operating ratio continue to rise. And so as that increases above 100, what that'll imply is that fleets will start extending their fleet age, both tractor and trailer, and or decreasing their asset base. The challenge with decreasing your asset base during a cyclical freight trough is that the secondary market is also depressed. And so there's a lot of truckload carriers trying to sell assets and not a lot of buyers, which depresses the values and makes it very difficult to sell. And so this would imply that 2Q is 1Q was financially very tough for truckload carriers. 2Q also looks to be pretty difficult and creates some headwinds heading into 3Q. So with that, there's always the discussion around capacity. And capacity is very difficult to really accurately measure in truckload because of the lack of holistic transparency and visibility in the space. And that's one thing we seek to increase at FreightWaves. The one way of measuring or isolating a variable for what capacity truly is Class 8 truck orders. Class 8 truck orders strongly correlate with spot market activity. And the large reason for that is most truckload carriers, even dedicated contract carriers, still have material spot market exposure. You might be 80-20 contract spot on head haul and, 35-65% contract spot on back haul. And so your net weighted average of contract to spot could be something like 65-35. And so as the spot market increases, so does their cash flows, and typically they reallocate that cash flow to purchasing new capital equipment. This past month or two ago, we saw the lowest ever net orders for tractors in the history of being measured by ACT and FTR. And what that meant is what net orders means is the totality of orders less cancellations, which was actually below zero. And so there were negative Class 8 orders at the beginning of the year. That's not a direct measure of capacity, but that plays into the future availability of capacity. We've seen insurance registrations drop by roughly 6%. And so that would imply that total capacity has reduced, but perhaps not to the full extent that truckload volumes have. And so you would still conclude that there's an excess of capacity in the truckload space, which could depress rates. And finally, we don't just look at truckloaded freight waves, we're fairly multimodal. And so with this last slide, I'm just showing intermodal volumes. I show intermodal volumes because the rails do provide a similarly comparable offering to truck through intermodal. There are differences. It's not the same service. It's not the same pricing. It's not the same origin and destination. You still have to contract with a drayage carrier. And so it's not a one-to-one comparison, but when the market does really very much so tighten, it pulls up intermodal volumes. When the market is very loose, it pulls down intermodal volumes. What you're seeing right now is intermodal volumes year over year down roughly 20%, call it, which implies that the truckload market is incredibly loose. Rail intermodal providers and IMCs are very price disciplined, and so they would rather take volume losses than price reductions because of their capital bases. And so they are not happy to take the 20% volume decrease, but they would much rather do that than reduce price. And so we do look at intermodal volumes as a heuristic as to the supply and demand dynamic in the truckload space. And then this green line, you're seeing intermodal spot rates, which are also continue to come down from their recent October 2019 peaks. And so with that, I'm going to hand it back over. If there's any questions later on or afterwards, I'm more than happy to answer them. Thank you all very much for your time.
Thanks, JT. We will come back. I also wanted to note that we had that Freightways had done some work showing a very tight correlation between diesel prices and freight rates, which makes a lot of sense. But I will say this, that when our colleague Zach Strickland did that study and the correlation was so tight, I was kind of stunned. I didn't think it would have been that tight because I would have thought that diesel prices could have also obviously been affected by oil macroeconomic factors. And so even though, you did have a kind of strange situation in March where you had truck rates soar and you had diesel prices plunging, the fact is they probably come and correlated a lot more since then. So that's a very interesting thing to note. So we're going to go now to, we're going to keep with our sort of status quo idea. Alan Schaeffer from the Diesel Technology Forum. Alan, why don't you tell us what's going on with that machine that rules the roost under the hood right now?
Thank you very much, John. Nice to be with you, everyone, and good morning. I'd like to share a few thoughts about, sort of and I must say the status quo comment is an observation. I would say that those in the diesel industry would say that diesel is doing anything but, marking time in terms of its technology. So maybe I'll have the chance to get into that a little bit. But thank you again for the chance to be with you all. A quick word about us. The DTF represents the leaders in clean diesel fuels and technologies. We have members that are in the fuel business, the renewable fuel business, engine and equipment manufacturers, really the leaders in the field And thank you all for all of them for enabling us to do what we do. And this is our 20th year doing it. So perhaps there's something to be said for that. I want to just begin with a framework for folks to understand why today's trucking world and really many, about 15 sectors of the global economy rely on diesel. And you know, it's a pretty compelling list of attributes. When you start looking at the very basics from energy efficiency, it is the most energy efficient internal combustion engine. And there's more to come. You'll hear that a couple of times from me today. It's a technology that's widely available. It's obviously proven over many decades. It's a high degree of availability, both in the fuel side as well as the parts and service network to serve an industry, a trucking industry that runs 24/7. And I think as we consider alternatives to diesel, that's going to be one of the key considerations in terms of uptime and reliability. And the other aspects I think I'll maybe just take a moment to highlight today are the transformation of diesel to now a near zero emissions technology, and more is on the way there. And then lastly, that this is a technology that can switch fuels overnight into a renewable fuel environment and dramatically impact carbon footprints. So those are all the things that make diesel a compelling technology today, and ones that will continue to make it a compelling technology in the future. If we take a snapshot at the trucking industry, diesel is the technology of choice. There's about 10 million diesel trucks out there, and you can see the distribution of other fuels and technology types. About 3/4 of those in the US are powered by diesel. And then of those, we're about 43% are powered by the newest generation of technology, and that's up almost 7% over last year. And I think the slide that JT just showed in terms of new truck orders obviously is going to impact the turnover of the fleet from old technology to new, and that's something that the industry will have to address. For those that are not tracking this technology, I think I just want to take a moment to look at kind of where things have gone over the last decade. And we've gone from a technology that has been, formally identified as having smoky trucks and smoky tailpipe emissions, down to one that is truly near zero now, with 98% reductions in some key pollutants of particulate matter and nitrogen oxides, which is a smog precursor for those of you not in the know. And there's more to come. And the question mark here, identifies kind of what happens next. And you can see the EPA is in the motion right now. There's an advance notice of rulemaking out to establish even lower standards for new technology diesel engines. And we expect those might kick in on the federal level around 2027. So diesel is a technology that keeps getting better all the time, and that's going to be key for the future. So just to level set everyone, what are we talking about when we say new technology diesel? It's really three things. It's the ultra-low sulfur diesel fuel that came into existence in 2006 in the US and has been standard since 2010 for all off-road and on-road diesel fuel applications. It's advanced engines and combustion technology, whether that's the fuel injection, the turbocharging, the advanced control of the combustion process itself. All of those things inside the engine have dramatically improved, driven largely by emissions, but also by efficiency. And then the last piece is the NOx and emissions and PM emissions control, and you can see a little diagram there on the left. And so when if we just want to focus on the largest trucks, and that is the ones I think that really one of the most focused here. 97% of the Class 8 big rig tractor trailers are powered by diesel, and 44% of those operating registered on the roads today are powered by the newest generation of these three features, and that's up over 7% from last year. So truckers continue to invest in the new technology diesel, and that's a good thing. So national average of that, about 43% of all the registered trucks in operation are of the newest generation. And you can see here on the map kind of a regional breakdown. We have some leaders and laggards. We have Indiana tops out at 65% of all registered trucks in Indiana are of the newest generation. And then you can find lower levels actually in places like California, which ranks about 45th out of 50 states for the newest generation of diesel. So we see this investment in new technology diesel all across the country. And that's important not only for the truckers that are using more efficient and productive technology, but also for society in terms of the benefits that are being delivered. And if we compared the new generation of diesel to the old, you would find that the lower levels of emissions have saved about 126 million tons of CO2 and 18 million tons of NOx. And that, translation from a fuel perspective, about 12.4 billion gallons of diesel fuel not consumed, and savings of nearly 300 million barrels of crude. And when you start looking at, solutions to different challenges, 126 million tons of CO2 equates to taking a lot of passenger vehicles off the road or making them zero emissions electric vehicles. So as we think about strategies to address climate change and clean air, it's important to look at all different perspectives and what's really being done today. And these are not things that are forecast and might happen if technology is adopted or fuels are changed. These are things that are happening today. Let's talk about the future. This is, future forward. I think 3 observations from my point of view, having been around this rodeo for a couple of times now. I think, first and foremost, as we all are anticipating, there's going to be a range of fuels and technologies in the future. And it's going to depend on a whole variety of things. And it's not a one-size-fits-all world today, and it won't be going forward. So I think first and foremost, that's important observation. And there's some really exciting things going on from all of our member companies in the areas of alternatives, and I'll speak to that in just a second. I think secondly, we will hope for a more efficient freight ecosystem, and that is a way to squeeze greater improvements in efficiency, not from the truck or not from the engine or the fuel type, but from the operation of the vehicle, and being smarter about how the vehicles are operating, how they're delivering goods, how we're ordering goods, and how those are moving through the entire supply chain. And then lastly, I think, the trends of connectivity and automation, autonomous features are already showing up in a range of different technologies and vehicles as standard applications. And so we think those will be a key part of the future as well. And of course, we will be part of the future humans. So, I don't think there's a sense that we're going to have fully autonomous trucks operating anytime soon. That could be a possibility way down the road, but I think we need to, narrow our beam a little bit and just look at what we can reasonably predict. So let's talk about the future a little bit. I just share with you a few observations from some of our leading member companies in technology. Volvo has a very interesting program in partnership with the California Resources Board called Volvo Lights, and they're looking at the whole ecosystem of moving freight and goods more efficiently in the southern parts of California around the ports area. And so it's not just trying out battery electric trucks in both Class 8 and smaller formats. It's also looking at fast charging and solar energy as prime power for some of those charging facilities. It's a very interesting program from a company that today is really a leader in advanced diesel technology. Same thing goes for Daimler Trucks. They've made the Freightliner e-Cascadia here is on the road in a testing format in California. And you can see the capabilities that are being expressed there, again, coming from a company that is a leader today in diesel technology and a large market share in the trucking sector. So as we see our member companies start to invest in new technologies and alternative fuels, I think that's going to be good for the industry as a whole to have more choices. And then the last example I would share is that of Cummins, which has got a really interesting way of looking at powertrains and mobility through electrified power. And it might be a hybrid drive system. It might be a system that's running fully electric. It might be a smaller combustion engine that's powering electric motors. It could be all of those things. And I think that diversity in applications really represents, I think, the way of the future. But for diesel, the future still looks pretty strong. I think that if we look at forecasters and those who study this area, and we do not, we just look at those that do, McKinsey, this happens to be IHS Markit, but they predict, pretty strong share of diesel in 2040, as you can see from this diagram. And, as expected, some of the alternatives are going to make some penetration into the sectors. I think the largest penetrations are probably going to come in the smaller weight classes, the class 3 through 6s, where there is a lot more activity and a lot more feasibility for some of the alternatives. where diesel will likely to continue to dominate the long haul sector for a very long time. If we think about just, how does diesel keep playing in the future, we think of it in these 4 ways. First of all, the technology has to get even cleaner. Emissions closer to zero is happening. There is a roadmap for that, both in California and EPA. As I mentioned, we expect that to be kicking in at 2027 or sometime thereabouts. More energy efficient engines and trucks are coming. Phase 2 greenhouse gas rules from the government, EPA and NHTSA, are being implemented as we speak. So we're seeing the benefits of those in terms of more productive, efficient, and lower fuel consuming vehicles. And again, largely diesel, but also some natural gas and other things in there. The other 2 pieces of diesel's way to the future are the use of renewables and hybridization. And I'll just wrap up with a few comments about renewables. I think that we often become fascinated with what alternatives are doing. We hear a lot about the investments in electric vehicles, for example, in California as part of their climate strategy. Well, it turns out that the use of renewable diesel fuels and biodiesel in California have delivered more CO2 reductions on a per ton basis than electric vehicles. And this is a pretty astounding kind of finding that, to continue to make clean air progress and climate progress, diesel is playing the lion's share of that right now. And I think as we are stepping out of a pandemic world here sometime soon, we hope, we have to be asking questions about whether or not fleets are more or less risk averse. Are they more or less likely to invest in new technologies that may require new things, infrastructure, et cetera? Or are they going to stick with what they know, what they have, and what works, and what they know can get the job done? So there's going to be some very interesting struggles and challenges for fleets down the road. And the final thoughts we have here, I think, this is again, status quo doesn't, it might be status quo in terms of being the dominant fuel in the industry, but it is one of continuous improvement. We think that using these advanced biofuels across the platforms and existing fleets, you don't need new vehicles to do this. You can overnight switch all the vehicles in an entire fleet, city fleet, municipal fleet, whatever, into renewable fuels and generate some very large benefits, very minimal investments. And I think, again, as folks look at strategies and cost effectivity, that could be one that starts to play a bigger role. As we said, the greatest suitability for alternatives coming likely in those shorter range deliveries and lighter duty vehicles, smaller vehicles, trucks, urban applications. And there are some serious refueling and charging issues that are not yet solved and from either a price or technology perspective or available at commercial scale yet. But the last point I want to make is that this is a big challenge. Climate and clean air is not something that any one technology is going to be able to resolve. I think it's going to take all of these things, and diesel is definitely going to be part of that. So with that, I'll stop talking and thank you, John, and look forward to questions.
Well, Alan, I called it status quo just to get your goat because I knew that would really drive you to make a presentation.
John, it's status quo to me also means gold standard, so that's okay.
Right, that's true. I also let's also note that the difference between renewable diesel and biodiesel. Renewable diesel can just pour right into the engine as is. Biodiesel needs to be blended, and there are some issues, some mechanical issues, particularly in cold weather with biodiesel, I guess coagulating, whatever. So renewable diesel and biodiesel are kind of from the same source, but different process to make them and get a final product that's used very differently. So Zane, you are the disruptor, or at least you're going to talk about disruption. So go ahead.
Thank you, John. Yes, it's wonderful to follow Alan here after having the stage set and having a good discussion about some pilot projects in the alternative trucking space. And so my name is Zane McDonald, and I'm the lead hydrogen and alternative transportation analyst for S&P Global Platts. And as John mentioned, I'm going to be taking the long view and looking at the long-term perspective of where trucking could be going and what alternative fuels might play a role in that. Now, at Platts Analytics, we are really quite preoccupied with energy. We maintain, as part of our scenario planning service, energy supply demand balances at the country level and at the sectoral level. And as a part of our service, we forecast these energy supply demand balances across different technology and policy scenarios. And increasingly, one of the most important scenarios that we've been paying attention to is a pathway to deep decarbonization, more particularly a pathway to a 2 degrees C world, staying within compliance of the targets set by the Paris Climate Accord. And as you can see from the graphic I'm showing here, sectors, all the sectors are looked to for some form of significant decarbonization, but the transportation sector, the road transportation sector, shown there on the left of this graphic, are asked in particular to bear a significant decarbonization burden. And commercial road trucking is not spared from this significant decarbonization. So why do we look to the commercial road trucking space for decarbonization? Here I'm showing the US commercial road trucking fleet in comparison to the rest of the vehicles on the road. You can see that commercial trucks in the US occupy about 5% of all the vehicles on the road. Now, despite only accounting for 5% of the vehicles on the road, commercial trucks account for nearly 10% of all the vehicle miles traveled. And despite accounting for only 10% of the vehicle miles traveled, commercial trucks account for well over 25% of all the fuel use in on-road transportation in the US. And so just a small number of vehicles, or a relatively small number of vehicles, have an outsized impact. And this absolutely makes the commercial trucking space an interesting spot to think about alternative fuels and an interesting spot to think about deep decarbonization. So this is a point that I think Alan made really well, and I just want to reiterate it. You know, I'm talking about commercial road trucking as if it were a monolith, when in all actuality, the sector is incredibly diverse. And one way to illustrate this, here I'm showing the duty cycles for about 300 Class 8 semi-trucks. And you can see a wide degree of variability in stops per trip, a wide degree in variability in miles per trip. And if we were to add extra dimensions onto this graphic, you'd see a wide degree of variability both in average speed per trip and the amount of freight hauled per trip. So this goes to say that it's highly unlikely that any one technology solution, any one alternative technology will be able to speak to each of these different truck duty cycles and each of the different use cases for this very diverse sector. So how do we think about it? How do we think about the alternative fuels that may or may not be applicable within this very diverse space? And so we try and put ourselves in the shoes of a truck operator and ask ourselves, how can I make the most money operating this truck? Or kind of flipping that on its head, how can I spend the least amount of money operating this truck? And that brings us to a vehicle's total cost of ownership. Now, total cost of ownership, as shown here, is the sum of both the capital cost of the vehicle, how much does it cost to buy a truck, and then all of the ensuing operational costs across the lifetime of this vehicle. That's your fuel cost, your maintenance cost, your fees, your taxes, the depreciation of the vehicle, all things considered. So here I'm showing the total cost of ownership for a 2019 long-haul truck, a Class 8 semi-long-haul truck. And I'm showing it for a diesel drivetrain, kind of the incumbent technology, a battery electric truck, and an FCEV, or fuel cell electric vehicle. And this is a hydrogen-powered truck. And so as you can see, the economics are very clear here that, as Alan said, diesel is the reigning champion. Batteries are far too heavy in these long-haul trucks. Hydrogen is still far too expensive of a fuel to fuel these long-haul trucks. And both hydrogen and battery electric trucks still have a significant purchase price premium versus a diesel. The trucks are still very expensive. So we know what the world looks like in 2019, in 2020. I want to think about what it could look like in a decade. So here I'm crunching the numbers with some advances in technology that we think are possible across the next decade. And, you know, as Alan said, the future of diesel looks pretty strong. Even with significant cost reductions in some of these alternative technologies, diesel still is on average the most cost competitive drivetrain in the long haul space. Now, that said, there's a great degree of variability in the future of hydrogen. And I've tried to illustrate that variability in the uncertainty bars that you see on these different forecasts. And I've highlighted with those red horizontal bars the bottom of that uncertainty bar, the bottom of that error bar for the fuel cell electric truck. And I want to show this because I really want to point out that fuel cell electric trucks within the next decade could be within striking distance of being cost competitive, and in fact more competitive on a total cost of ownership basis than a diesel truck. So how do you get there? What's a pathway look like to get to the bottom of that error bar? So one thing that's of key importance is achieving scale in manufacturing. Governments around the world have a pretty strong appetite to increase the amount of hydrogen within the mobility space. And to do that, they've set targets. And I've aggregated some of those targets here. And we believe that if these targets are achieved, it will provide enough scale in manufacturing for the fuel cell electric, the automotive fuel cell electric manufacturing industry to put enough downward pressure on the automotive fuel cell to drive significant cost reduction in the purchase cost of that fuel cell electric truck. So given the scale of these automotive hydrogen mobility targets, we think that we could see upwards of a 40% reduction in the purchase price of a fuel cell electric truck across the next decade. Now, purchase cost is just one aspect of the total cost of ownership. We also have to consider operational costs. As you can see, given today's technologies, operating a fuel cell electric truck is incredibly expensive, over $3 per mile to operate. And this is really because the fuel is incredibly expensive. Right now, hydrogen in the transportation space is going for about $13 per diesel gallon equivalent. It's astronomical. So obviously, for this to be a competitive fuel, we need to see significant cost reductions there. So how do you see significant cost reductions in the price of hydrogen? Hydrogen is a commodity. And so hydrogen, once produced, can be used in multiple sectors. It's not pigeonholed into the transportation space. So if we see increased uptake of hydrogen in the steel production sector, in the fertilizer production sector, in refining, in bunkering, in industrial heating, all these other applications that hydrogen could play a potential role in, then we'd see the cost of hydrogen production start to fall. Another area where you could see significant cost reductions in hydrogen, in delivered hydrogen cost, is the cost of hydrogen transportation. And here I mean moving hydrogen from its origin to its destination. Right now, hydrogen transportation, moving hydrogen, can account for 50 to 85% of the delivered price of hydrogen. So investments into multi-access hydrogen transportation infrastructure and the development of a hydrogen spot market to facilitate transparent transactions of hydrogen could really drive significant cost reductions in the cost of delivered mobility hydrogen. So I've talked at length here about the pathway to an alternative long-haul truck. So I want to take this graphic that I'm showing you here and kind of pivot just a little bit and think, instead of a 2030 long-haul truck, what does a 2030 short-haul truck look like? The economics here are much more clean-cut. Battery electrification has a significant cost advantage over diesel in the short haul space in the long term, in our opinion. And really, this comes down to the range of the vehicle. A much shorter range of a truck, much shorter required range of a truck reduces the size of the battery. This benefits the economics of the vehicle in two ways. One, a smaller battery costs a lot less, so the purchase cost of that truck comes down. And two, a smaller battery reduces the weight of the truck, and reduces the weight of the truck significantly, up to 40% in fact. And so when you have a much lower weight of the truck, you reduce the economic penalty of freight that you can't haul when your battery is really large. For each kilogram of additional battery that you put on a truck, that's a kilogram less freight that you can haul. And there's a cost to that, in addition to the fact that a very heavy truck is going to be less fuel efficient. So this 2030 vision of a regional haul battery electric truck that I'm showing here, it's not strictly theoretical. In fact, we're already starting to see these economics playing out in the urban bus space. Heavy duty urban buses have already seen a very strong thrust into battery electrification. And it fits a lot of the same tenets that I've talked about already for a short haul truck. The daily range is less than 100 miles for the typical urban bus. And this puts it well within the capabilities of current battery technology. The annual fuel demand is outsized because of their stop-start patterns, operational patterns, similar to a regional haul truck might be, and because of their low fuel efficiency. And finally, urban buses have large wheelbases, and the freight that they haul, relatively speaking, is fairly light. And so this really relaxes that weight constraint that we talked about earlier. And because of these economics, because of this favorable situation for battery electrification, across the past 6 years, we've seen well over 400,000 battery electric buses in operation in cities around the world. So kind of putting a little bit of a bow on my discussion points today, hydrogen is a very light fuel, and this makes it a good applicant for long haul heavy duty trucking. But we still have to see significant cost reductions in production of the fuel cell electric vehicles and some scale in hydrogen production. And that scale in hydrogen production can be driven by the development of cross-commodity hydrogen markets and through investment in hydrogen transportation infrastructure. Now, turning our attention to battery electric trucks, the weight of the battery is key, and moving to lower range applications de-emphasizes the weight of that battery and can really help tip the economics toward battery electric trucks. Now, within both of these alternatives, risk aversion, infrastructure development are both still key uncertainties, and something that the market's going to have to grapple with, as well as policy and regulators are going to have to try to address. And with that, I want to thank everybody for your time, and I'm going to turn things back over to John.
All right, we've got questions, and they've come in pretty strong here. Two of them I'm going to pull together because I think they're very similar, and they are for Zane. One question is, how does the source of hydrogen play into your calculations? Electrolysis with nuclear power versus methane, or electrolysis with only wind or solar? And then from Peter Stewart, who was a former colleague at Platt, Zane, he worked at Platt for many years. I would be interested in Zane's thoughts on what are the potential carbon savings from using FCEVs, and to what extent these depend on truck range, hydrogen technologies, et cetera. So they're kind of similar questions in terms of, and I had prepared some questions in case we didn't have any, which we've got plenty. And I prepared a question very similar. I mean, you could theoretically at one extreme produce hydrogen from coal, but if you produce hydrogen from coal versus hydrogen from a wind turbine, it's obviously very different in terms of a carbon impact. So what are your views on that, Zane?
That is an excellent question. Hydrogen is very frequently discussed as a clean fuel of the future, when in all actuality, hydrogen is nothing more than an energy vector. Similar to electricity, you can have hydrogen produced from coal, and the carbon footprint of that hydrogen parallels that energy source. Conversely, you can have hydrogen produced strictly from renewables, and that hydrogen is going to have a zero carbon footprint. So the hydrogen footprint is key when we talk about the decarbonization of these trucks. Now, very different from a battery electric truck, the battery electric drivetrain is incredibly efficient. A battery electric truck can see a fuel economy equivalence of over 40 miles per gallon. Hydrogen trucks are not that efficient. So you don't get this huge efficiency boost in a hydrogen powered vehicle. So the carbon footprint of a fuel cell electric truck really comes down to the carbon footprint of the hydrogen used. Now, what hydrogen do we anticipate being used in these trucks were they to go viral? Already we're seeing indications from policymakers as they try to steer that ship. The California low carbon fuel to qualify for credits within the California low carbon fuel standard, you have to have at least 50% zero carbon hydrogen blended into the hydrogen you sell into the mobility sector. And that's not just in the United States. Germany just announced their own hydrogen strategy, and they're only subsidizing the use of electrolysis. And this is the pathway to utilization of renewable power to produce your hydrogen. So policymakers are trying to get ahead of this ball as it's rolling down the hill. And they see the impact of the feedstock energy on the carbon footprint of these potential fuel cell electric trucks. And it's going to be key, definitely. Good question.
Let me jump in. There's another question, and I think it's probably directed at Zane, but I'm going to actually bring it to Alan first because I think it's relevant. Platts started recently, I think you made reference to it, Zane, assessing hydrogen. Now, there's no free market price of hydrogen. So they put together some kind of algorithm using various inputs and produced a value for hydrogen. But that's not the cost that you'd be recharging. And this one question is, electrical vehicle operating costs are also dependent upon electricity costs. And electricity costs can be very politically driven. That's my comment, not the questioner's. What assumptions have been made on electricity cost? On the consumer side, we are paying 32 cents per kilowatt hour in Northern California now. So, Zane, you're very popular here today, but I do want to ask Alan, in your calculations, what sort of numbers do you assume for diesel going forward if you look at the competitiveness of diesel versus hydrogen? And then, Zane, we can come back to you on the, how much does the retail cost of electricity matter here versus the cost of hydrogen?
Well, I think it's so hard to really answer that question, because today we can do great analysis as Platts and FreightWaves does on diesel fuel pricing and historic trends, and we can crunch it down to the couple decimal points. So we can reasonably predict that we're going to have diesel fuel prices between the $2, $3, $4 range sometime in the next 5 to 10 years. I think we have it now, and we've had obviously we've had those prices in the last 5 years. That hasn't really deterred folks from investing in the newest generation of diesel, as I pointed out. I think the other thing, though, that what is the relationship there with hydrogen pricing? To me, there's so much uncertainty. How do you say? I mean, how do you show that? I think Zane did a nice job of really level setting folks on what the expectations are of trying to figure out where things become price competitive. But it's not just the fuel price, as we know. It's the whole supporting infrastructure. It's the certainty about where you can get it. I mean, if your truck runs out of electricity on some road because something happened or whatever, I mean, what does that mean for the fleet? Those are, in my mind, those are the kind of things that are going to be bigger showstoppers than the absolute price of fuel, because nobody's going to be watching that. But if your delivery is late, it doesn't show up on time or whatever, people are going to be watching that. So for the fleet folks, it's going to be a proposition to go from something that and understand innately to folks that might not, the pricing of the fuel, the availability of the fuel. Even though there's the dozens of stations or hundreds of stations, it still doesn't get us to that point of well over 150,000 stations where you can get diesel today. So it would be very hard to kind of say that. I think manufacturers, there's some exciting things going on there. And from the technology on the engine side, that feels kind of interesting. But, the fuel supply and infrastructure, that's where the biggest challenges are.
JT, let me ask a question of you. You've been studying this for a long time. I mean, long before you became the Freightwaves at Stiefel, and that's a top-notch transportation research group. Where's your view? Where do you see 20 years? I think the consensus that I found in the trucking business is that batteries are a no-go because of some of the issues that Zane referred to. They're very heavy, and that hydrogen is the most likely alternative. So what's your long-range forecast for what you think is going to be propelling trucks? I think everybody would agree diesel would be the most. So what is the sort of second most?
Yeah, that's a great question. I think talking through some of the short-term challenges and how we can get over them are the best way to set the baseline for long-term trends. Alan mentioned something really critical, which is service levels. And service levels in trucking are directly interrelated to pricing power. And so the ability to maintain high service levels, and truckers are required to maintain very high service levels because stock out costs drive a lot of opportunity costs, not just in terms of revenue, but in terms of balking amongst consumers, which has issues for brand erosion. And so to the extent that a trucker is confident that if whatever happens on the road and they need to refuel, that they can refuel within a given radius, that they have a high level of confidence, then the adoption level will increase. Without that, they're going to have to plan in provision capacity in case there is a energy related breakdown to ensure that they can pick up that freight and then bobtail an electric truck back to wherever it needs to go. And so service levels are critical.
Let's note that for those who don't know trucking, you want to define bobtailing.
Yeah, so it's moving the asset unloaded, and if it's a function of being lacking sufficient fuel reserves, then they'll have to call a tow truck, which has another double down cost implication. And to Zane's comment regarding the weight of batteries, that's relevant. I would complement that by saying the corrosion and the environmental impacts of something going wrong with a battery is far more material than a leaking diesel valve. And so there are implications for that, both in terms of the remediation costs, but then also the ability to drive secondary market value for the assets, which for large contract carriers is material because they all have an asset trade cycle with the expectation that they can sell the assets after a couple of years. And so those are important characteristics to consider as well. I think
we don't have a lot of time. I do want to get to one of the other viewer questions. This comes from ML Franklin. Zane's TCO comparison shows diesel and EV economics being similar. Does this take into account time lost to battery charging?
Great question. Really awesome question. It does. And we take in, the way we factored that in is by including demand charges within our battery charging economics. The demand charge, when a given consumer exceeds a utility's threshold, the utility then starts to levy an additional fee onto that consumer to account for the high capacity lines that the utility is going to have to operate to that given consumer. And so by factoring in demand charges, we are assuming that charging infrastructure has the capacity to operate very high speed charging. Similarly, we also tried to, in our TCO analysis, compare apples to apples to apples to apples as much as possible. And in doing so, we modeled vehicles that had similar ranges. And so we put huge batteries onto these theoretical vehicles to account for the range of the vehicle, assuming that any truck operator would be able to go just as far as their diesel counterpart, and then would encounter and pay for high powered charging. And so that would put you within a 20 to 30 minute charge cycle.
Okay, I'm going to squeeze in one more, Dave, Dave Williams, if that's okay. I think this is probably more for JT. How long does it need to adopt new technology trucks? Many retailers, transporters would take a long time to start changing their fleet to up-to-date technology. So I really think this really has to do with how fast fleets turn over.
Yeah, I mean, I think ultimately electrification and alternative fuels more accurately certainly is the way of the future. It's really a question of how do you get there. And in terms of raw adoption, if every fleet was to say we want to fully adopt now, the average tractor age for a large fleet is, call it 2 to 3 years. And so if it's 3 years just to be conservative, you would need 6-year period on average just to cycle through the whole fleet. So that's kind of a way to think about it, just in very generic terms.
Okay, unfortunately, we have a few unanswered questions, and I think we'll probably have unanswered questions in this field for probably years to come. But we're also out of time, so I want to thank Alan Schaeffer and JT Engstrom and Zane McDonald. Dave, I don't know if there's a provision for how we answer unanswered questions by email. Maybe you can talk about that. But otherwise, I want to thank everybody for listening in, and let me turn it back to Dave.
Oh, thank you. Thank you very much, John, and to our distinguished panelists for an outstanding webinar. I know I personally enjoyed this quite a bit, so really appreciate your time and efforts. Yes, questions will be fed back to you as our panelists to address. For all of those listening, please keep in mind that this webinar has been recorded, will be archived on our website this afternoon so that you can share with your colleagues. As a reminder, please, if you're not a member of IAEE, please consider joining our forum by visiting us at www.iaee.org. Thank you once again for attending, and I officially close this webinar.
Thank you.
Thank you.